Hello everybody and welcome to our webinar on tax effectively managing the sale proceeds of a business or significant asset. Shortly I'll throw over to Kate Salkeld, who will be presenting the webinar today, but first a couple of housekeeping issues. If you'd like to ask a question, you can do so by entering it into the chat button. Now Kate does have a long presentation today, so we'll keep questions towards the end, just so we can keep track of time. But if you do have a question, put it in the chat box and I'll relay it to Kate. If you'd like to copy or download a copy of the slides, you can do so by clicking on the Files button. You'll be able to download the slides there. A reminder, this session will be recorded and will later be put on YouTube. So obviously with your questions, we moderate them anyway, but keep out client names or anything like that if you're inclined to put them in an email. So I'd like to throw over to Kate. As I said, she's got a lot to go through today. So over to you, Kate.
Thanks, Adrian, and hello, everyone. Thanks for being here today. Today, we'll be focusing on a stage of the business sale process that doesn't always get the attention that it deserves, and that's what happens after the sale. Specifically, how to extract the sale proceeds from the entity in a way that's both tax effective and strategically sound. And of course, this is a very different exercise to withdrawing regular operating profits. When a business or a significant asset is sold, the scale of the proceeds and the resulting tax consequences, they call for a more considered and technical approach to the process. So in this session, we'll be diving into some of the more complex aspects of the Australian tax law that apply here. We'll look at how to confirm and how to leverage pre-CGT asset status. We'll look at how the small business CGT concessions impact on the extraction of proceeds and how franking credits can influence your options. We'll also explore the pros and cons of retaining versus winding up the entity, how earn-out arrangements affect timing and treatment, and also how asset protection needs to be balanced with tax efficiency. So the aim here is to give you a clear framework for advising clients through what is often a once-in-a-lifetime financial event and helping them achieve the best possible after-tax outcome. So let's begin with a look at pre-CGT assets and why getting that classification right is so critical. So, as you'll know, CGT only applies to assets which were acquired on or after 20 September 1985. So if the asset was acquired before that date, it's generally exempt from CGT on disposal under Section 104-10, subsection 5 of the ITAA 1997. But that exemption is only available if the asset retains its pre-CGT status throughout its ownership. And that's often where things go wrong. Seemingly small changes like restructures or ownership shifts can inadvertently strip away that exemption. If preserved, though, the benefit can be substantial in that you've permanently sheltered a capital gain from tax. So confirming and maintaining the pre-CGT status is really essential in any business or asset sale that involves older holdings. So there are a few key elements to both establishing and maintaining the pre-CGT status. First is the acquisition date. As I said, it needs to be before 20 September 1985. And acquisition includes not just purchases, but inheritance, certain rollovers, and other deemed events under the CGT rules. Secondly, we need to watch for ownership changes. Any post-1985 change in the legal or beneficial ownership of the asset will usually cause the asset to lose its pre-CGT status. And this includes transfers between individuals or to a trust or company, even without any consideration. Also important is Section 149-30, which says that if more than 50% of the underlying interests in an entity holding the asset change hands, so more than 50% of the shares in a company, for example, then the pre-CGT asset will be treated as post-CGT. There are some other events which can impact the pre-CGT status. So even without a transfer, there can be certain events that affect status. One of those is capital improvements. If post-1985 improvements exceed a certain value, either an index threshold or 5% of the asset's market value, then those improvements can be treated as separate post-CGT assets under taxation ruling 2004/18. Also, changes in asset use, like turning a residence into a rental, they don't reset the CGT clock, but keep in mind that they could have indirect effects. And for equity interests, CGT event K6 can apply. If you sell shares or units in an entity where more than 75% of its assets are post-CGT, you may be taxed even though the shares themselves are pre-CGT. So those are some other events to keep in mind when considering the pre-CGT status of an asset or an entity. So once a pre-CGT asset is sold, the next question is, how do we extract the proceeds tax effectively? And we'll go through this in more detail later on in the webinar, but just considering it from a pre-CGT perspective, if held in a company, the gain will be exempt at the company level, but any dividends paid to shareholders from those proceeds would be fully taxable under Section 44, subsection 1, regardless of the CGT exemption. And franking credits can help if available, but where they are unfranked, the tax cost will sit with the shareholder. You could instead do a return of capital and trigger CGT event G1. This would reduce the shareholder's cost base, and if the return exceeds the cost base, then a capital gain will arise. But both ASIC and the ATO scrutinise this in a fair bit of detail, meaning that proper documentation is really critical. And again, we'll come back to this in further detail later on, but in some cases, liquidating the company could be the better option because it may allow the shareholder to apply CGT event C2 or G1 to preserve the CGT-free nature of the proceeds. But Section 47, subsection 1, can deem some liquidated distributions to be dividends unless they are from pre-CGT capital profits. So it is essential to take care in this regard. Looking at extracting the proceeds from a trust perspective, if the asset is held in a discretionary or a unit trust and it retains its pre-CGT status, the proceeds can generally be distributed to beneficiaries without triggering tax. However, we do need to make sure that the trust deed allows for appropriate distribution, that the capital gains are being streamed correctly under subdivision 115C, and particularly in regard to unit trusts, that CGT event E4 is being managed to avoid triggering gains from any tax-deferred distributions. Now, where post-CGT components are involved, like improvements or any concurrent asset sales, the small business CGT concessions under Division 152 may be available. Again, we'll come back to this in further detail, but in this case, you would need to meet the active asset test, plus the turnover or the net asset threshold and the relevant participation percentage rules. The key concessions would include the 15-year exemption, where there's a full exemption if conditions are met, the retirement exemption, up to $500,000 excluded, and also rollover relief, which defers the gain if it's reinvested into another active asset. Just a few final points on some of the technical and practical considerations of pre-CGT assets. First is that stamp duty can still apply depending on the jurisdiction, even where CGT doesn't. That's something to definitely keep in mind. For deceased estates, pre-CGT status is generally preserved under sections 128.10 to 128-20. But there's always a trade-off between asset protection and tax efficiency, in that transferring assets to new structures can trigger CGT or duty, or could cause a loss of pre-CGT status. But above all, in terms of pre-CGT assets, it's important to keep good documentation in terms of acquisition records, valuation reports, trust resolutions, and also to reference any relevant ATO rulings, because without that detailed paper trail, preserving the pre-CGT treatment could become very difficult. Moving on from the pre-CGT analysis, we'll now look at the pros and cons of retaining the entity, winding it up after a significant one-off sale, and also establishing a new structure. So once a major business or asset sale has occurred, the question often becomes, what next for that entity? Broadly, there are three strategic options that you have. Firstly, to retain the entity post-sale. Second, to wind it up and distribute all of the proceeds. Or to establish a new structure for future investment or succession planning. And of course, each pathway has its pros and cons across tax efficiency, risk management, and strategic flexibility. And the right choice out of the three will depend on both legal and commercial factors. Let's first look at the pros and cons of retaining the entity. So retaining the entity can be attractive where legal continuity is important, as it will allow the same legal entity to continue holding warranties, indemnities, or any deferred consideration obligations, which in some situations can simplify the post-sale risk management and avoid any contract novation. From a tax standpoint, an important aspect is that sale proceeds can be retained with tax on distributions potentially deferred, especially in companies where franking strategies can be utilised. And this can allow for timing flexibility and potentially better after-tax outcomes. Also, it would allow for reinvestment within the existing structure to avoid any immediate CGT or stamp duty, which could potentially arise if proceeds are distributed and reintroduced elsewhere. On the downside, keeping the entity would trigger ongoing compliance obligations, financial statements, asset filings, tax returns, etc., which may be unnecessary if it's a now inactive business. There's always a risk of dormancy-related issues or accidental non-compliance with some of those obligations. Distribution could be tax inefficient, for example, double taxation through corporate earnings or shareholder dividends, or limitations in streaming income through a fixed structure, depending on the availability of franking credits, for example. And importantly, possibly the most important aspect, is that the entity will retain residual liabilities, including potential audit risk, legal claims, or unresolved indemnities. So for that reason alone, if the entity is no longer trading and there's no need for that entity anymore, many people will choose to wind it up to avoid that risk. So alternatively, the entity could be wound up after the sale of the business or the significant asset. The pros here are that, firstly, it offers a clean break It ends the legal existence of that entity and it removes any compliance or admin obligations. It also allows for formal distribution of proceeds to the owners, which of course may give rise to CGT events, but it may also trigger eligibility for the small business CGT concessions under Division 152. And lastly, winding up can help crystallise the outcomes and limit any future exposure, which is especially useful where there's no earnouts or any ongoing liabilities that remain. In terms of the cons, the trade-off is that winding up will typically trigger immediate tax consequences, including CGT on asset disposals and possible tax on liquidated distributions. Also, the entity cannot later be reused. So if there's a new venture that emerges down the track, you'll need to establish a new structure from scratch. And lastly, the process may be costly and complex, especially if we're involving liquidators, statutory notices, final tax lodgements, etc. The third option is to establish a new structure, especially where the client's goal is to preserve wealth, invest sale proceeds, or engage in estate planning. In terms of the pros, firstly, the new structures can be customised for tax efficiency. For example, discretionary trusts will allow for income splitting, or holding companies can optimise dividend streaming and franking. Trusts in particular, they provide strong asset protection and they can shield the sale proceeds from future creditors. They also enable succession and estate planning with tailored governance rules, long-term control, and also intergenerational flexibility that can be built into the structure. And as for commercial needs, a new structure can support a number of different joint ventures and other types of investment strategies. However, in terms of the cons, depending on what the particular structure is, the setup may not be cheap. Of course, there will be legal and advisory costs and ongoing regulatory requirements, especially with companies or trusts. And with some structures like discretionary trusts, there may be governance concerns, especially if control over the trustee decisions becomes misaligned with the original intentions of the owners. So how do you choose between the three different options? We should start with a review of, firstly, the tax consequences, including any potential CGT events, the availability of the small business CGT concessions, and also any franking strategies that could be employed. We'd also want to review any ongoing legal or commercial risks like warranties or indemnities that may require the original entity to stay in existence. We'd also want to consider the future objectives of the client, whether they're planning to reinvest those funds, exit completely, or pass on wealth to future generations. And lastly, we need to consider the compliance burden, weighing up the cost and effort of maintaining each option relative to the benefit that they will provide. So just to wrap up this section, we recommend often that you retain the entity if there is deferred consideration or reinvestment plans or some other reason within the contract that requires that entity to stay in place. Otherwise, it's often recommended to wind up the entity if the goal is to create a clean break and the entity has served its purpose, it's no longer required. But if the client is wanting to pursue future investments or looking at other tax planning or succession elements, in that situation, you might look at using those sale proceeds to establish a new structure to meet those reinvestment goals. Whichever option the client looks at pursuing, we need to make sure we're always looking at the availability of the CGT concessions under Division 152, and also the overall flexibility, control, and long-term efficiency of the structure that they're using. Next, we'll turn to the availability and use of franking credit entitlements and how this interacts with decision-making in the event of a business or asset sale. As we know, franking credits are fundamental to the Australian imputation system, as they provide shareholders with tax offsets for corporate tax that's already been paid by the company to effectively avoid any double taxation. So when selling a business or a significant asset, utilising franking credits efficiently can make a major difference to the after-tax outcome. Unlike any routine dividend payments, any large one-off sale proceeds requires some deliberate planning to make sure that we're maximising the benefit of any franking credits. And so the structure of the sale, the profile of the different shareholders, and the way in which the proceeds are distributed, all of these aspects can significantly affect both the availability and the use of any franking credits. So we'll look at the franking credit implications of an asset sale as compared to a share sale. When we're looking at an asset sale, we know that the company will retain ownership of the shares and therefore the franking account balance as well. The sale proceeds will remain within the company and can be paid out as franked dividends later on. And this would give flexibility to time the various distributions strategically to align with the shareholder tax profiles and to optimize the utilisation of franking credits. On the other hand, with a share sale, ownership of the company and its franking credits will transfer to the buyer. So post-sale, sellers will lose access to these credits, which will obviously reduce their ability to extract these proceeds tax efficiently after the sale. So when considering an asset versus a share sale from a franking credit perspective, it's really essential to carefully model both scenarios and to weigh the tax advantages of retaining the franking credits against any commercial or operational considerations that might exist for the client at the time. As I mentioned, another aspect that can impact on this side of things is the actual tax profile of the various shareholders of the company. So where we have resident shareholders, we know that we can offset their tax liabilities with any attached franking credits. And if the credits exceed their tax owed, then the excess will be refunded to them as cash, which can improve their after-tax returns. Non-resident shareholders, on the other hand, they generally can't claim any refunds that might arise, but the franked component of a dividend will be exempt from Australian withholding tax. In contrast, any unfranked dividends could attract the withholding tax up to 30%, subject to the application of any tax treaties. So just a tip in terms of shareholder tax treatment is it's important to conduct a detailed review of the shareholder register, particularly where we're dealing with large companies with many different shareholders, to best align the distribution strategies with the tax residency of the different shareholders, as well as their marginal rates of tax, to try and maximise the overall tax efficiency. Next, we'll look at the distribution methods in terms of declaring a dividend versus having a capital return and how that interacts with franking credits. So, of course, franked dividends, a distribution of sale proceeds as franked dividends will reduce the shareholder tax through franking credits. but this will require sufficient franking account balances and also needing to make sure we comply with the timing rules in that aspect. Capital returns, on the other hand, so alternatives like share buybacks or capital reductions, they're generally tax-free as income to the shareholder, but of course they can trigger CGT for shareholders depending on the cost base of those shares. So often a blend of both franked dividends and capital returns can provide the best balance to maximise the use of franking credits whilst also minimising CGT exposure. Just touching on some of the anti-avoidance and integrity rules that can also apply here. So the use of franking credits is tightly regulated to prevent abuse. The first of those is the 45-day holding period rule, in that shareholders need to hold shares at risk for 45 continuous days to be able to claim any franking credits. We've also got the dividend streaming provisions, which prevent selective allocation of franked dividends to certain shareholders. We've got the broad anti-avoidance rules under Part 4A and Section 177EA, which can invalidate schemes which are designed to generate or increase franking credit benefits artificially, and also the recent amendments which limit attaching franking credits to distributions which have been funded by capital raisings or non-taxed sources. So these rules all need to be kept in mind when considering franking credit strategies. And we would often recommend obtaining legal and tax advice to make sure you're properly navigating these rules and not incurring any penalties to best secure those franking credit benefits. So to sum up the key recommendations in terms of coming up with a franking credit strategy, we need to make sure we're reviewing the company's franking account balance and its retained earnings. We need to make sure we're analysing shareholder profiles, looking at their tax residency, their applicable tax rates, and any eligibility for a refund. We need to consider the impact of the sales structure, whether we're conducting an asset sale or a share sale, and how that will impact on franking credit retention. We need to develop a distribution plan, which often will combine franked dividends with capital returns. We need to make sure we're complying with any anti-avoidance, holding period and streaming rules that exist under the legislation, all of which the goal is to maximise the after-tax returns while trying to maintain flexibility for future tax planning for the client. Moving on from franking credits, we'll now look at the application of the CGT small business concessions and how that interacts with the extraction of proceeds across different entity structures. So as I mentioned earlier in the webinar, Division 152 of the ITAA 1997 provides 4 key small business CGT concessions: the 15-year exemption, the 50% active asset reduction, retirement exemption, as well as the small business rollover. And these concessions can eliminate or defer tax on capital gains that arise from CGT event, often A1 disposals, and can significantly impact on the post-sale tax profile and how those proceeds can be extracted from the entity. So the entity structure can strongly influence the application of the concessions. It will affect the eligibility criteria, the method of extracting proceeds, and also the tax treatment of the proceeds, which may be treated as non-assessable, non-exempt income, frankable dividends, or capital distributions, depending on the relevant entity type. So here I've set out a comparison how the particular entity type will impact on the eligibility and application of the CGT concessions. Of course, all of the different entities need to satisfy the active asset test and the significant individual tests. When we're dealing with a company, we'll be looking at the percentage of shares owned by each shareholder. With a unit trust, we'll be looking at the percentage of units held. Whereas when we're dealing with the discretionary trust, we need to employ some more complex analysis as to the recent distributions by that entity. However, we need some precise trust deed provisions to qualify for the different concessions. But yes, I refer you to that table to compare how the different entity can impact on the application of the concessions. Specifically looking at companies, so under the 15-year exemption, the capital gains will be disregarded at the company level and no franking credits will arise as the gains are not assessable income. And any retirement exemption payments to stakeholders would be treated as non-assessable, non-exempt income to the recipients and also would be non-deductible to the company. Dividends from retained proceeds could be frankable if they're paid from assessable profits, but the franking capacity can be reduced if there is an exempt gain which arises as a result of the sale. From a unit trust perspective, capital gains will retain their character when they're distributed under Division 115C. And CGT events E4 and E7 can be triggered on these distributions where they exceed the cost base or when capital entitlements are satisfied. So when we're dealing with unit trusts, we need to make sure we've got careful deed drafting and also distribution documentation to make sure we're not having any double taxation occur there. From a discretionary trust perspective, discretionary trusts do allow trustees to allocate capital gains to particular beneficiaries, and this is often done to optimise the tax outcomes. However, we need to make sure that the trust deed explicitly allows the streaming of capital gains, and as we know, the trustees need to pass resolutions by 30 June to allocate the gains appropriately, and a failure to comply with this timing can lead to the gains being taxed at the highest marginal rate within the trust, which is never ideal. So just a few key procedural and timing points in relation to the CGT concessions. So electing for the 15-year exemption and the other concessions within the tax return, we need to make sure this is being completed appropriately. If we're applying the retirement exemption, we need to make sure that there's a timely payment or contribution to superannuation, especially if the recipient is under the age of 55. If we're dealing with replacement assets, we need to make sure that those are being acquired within 2 years of the CGT event, because missing any of these deadlines or failing to document them properly can result in that entity being disqualified from the concessions or could lead to a reversal of the tax benefits. So definitely need to keep in mind these different requirements when looking to apply the concessions. A couple of technical risks and common pitfalls to bring to your attention. First one being company dividend trap. If we are having an exempt gain within the company, of course, this will reduce the franking credit capacity, which could lead to unexpected tax on shareholders when the dividends are paid. And also from a unit trust perspective, if there is an incorrect streaming or if they exceed the cost base, the distributions could trigger a CGT event, which could cause unintended capital gains for the unit holders. Also, in relation to discretionary trusts, if we don't have those explicit trust deed provisions and proper resolutions, then capital gains could be taxed to the trustee at the top marginal rate, which would be a costly outcome. And then also the retirement exemption timing risk, making sure that superannuation contributions are made by the lodgement deadline so as not to invalidate the exemption, to make sure that we don't have full taxation of that gain. So just a few recommendations to make sure that we're getting the most out of the Division 152 concessions. We need to make sure we're confirming eligibility, including looking at the entity type, making sure it's an active asset, and making sure that we have the significant individuals that we need. We need to make sure we're tailoring the extraction strategies depending on the entity type. So looking at dividend modelling for companies, making sure that we've got the correct capital streaming provisions, and conducting deed reviews for trusts. Making sure that the deeds and the constitutions allow for capital distributions and gain streaming. Timing, making sure that we're lodging the elections and resolutions when we need to, and also monitoring any superannuation contribution deadlines if we are using the retirement exemption. So when we have existing structures that perhaps limit concession access or make extracting the proceeds not tax efficient, we may want to consider a pre-sale restructure. But ultimately, making sure that we're planning in a proactive way and making sure we're complying with the various requirements, that's all critical to make sure we're maximising the tax benefits that are available under Division 152. Okay, now we'll look at the tax treatment of winding up a company in terms of liquidating the company versus deregistering the company. So when we're winding up a company, there are two main options: liquidation being the first one, a formal process with a liquidator appointed under the Corporations Act, or we have deregistration, which is a simpler administrative process via ASIC, used only where the company is dormant and it has minimal assets. So some of the key tax considerations that we need to weigh up include: what are the resulting CGT implications for shareholders? Can we access the small business CGT concessions? Can we distribute the retained earnings and franking credits, as well as any compliance and residual risks? So looking at liquidation first, CGT event G1 will occur when shareholders receive a return of capital. If this payment exceeds the cost base, then a capital gain will arise there. We also have CGT event C2, which would be triggered when the shares are cancelled, which typically happens at the end of the liquidation process. And shareholders would be deemed to dispose of their shares for the value of the final distribution. Now, if the shares or the company assets are pre-CGT, the gains might be exempt, but of course we need to employ caution in, as I identified before, that changes in use or structure could potentially affect that status. Also, if we've got G1 distributions happening over time, we need to make sure they're being reconciled properly with the final C2 event to avoid any double counting. And also just mentioning that the liquidation costs, like liquidator fees or legal advice, they are generally deductible under Section 8.1 as long as they are properly incurred in ceasing the business. Now, if the company qualifies as a small business entity and it sells business assets before liquidation, then, as we went through previously, the Division 152 CGT concessions could apply. Again, just a note there as to the timing requirements of applying the retirement exemption, which would need to be complied with. In terms of franking credits on liquidation, distributions in liquidation are often deemed dividends under Section 47 of the ITAA 1936, but only to the extent that they represent profits. And these dividends can be franked to reduce shareholders' tax if the company does have the necessary franking credits, but returns of capital are not frankable, which is an important planning point, particularly where we do have retained earnings and franking accounts within the company. Just a few final compliance points to note. Of course, we would need to, before the liquidation is finalised, we would need to lodge that final tax return, cancel any GST registrations, finalise PAYG withholding obligations, and to distribute any remaining franking credits via a dividend statement. And this is to make sure that the company is fully tax compliant before it ceases to exist. In addition, from an ASIC perspective, we need to make sure we're lodging an annual administration return and a final return with ASIC to make sure that ASIC is also made aware of the liquidation of that company. Deregistration being the other alternative to winding up a company. This is a simpler approach, but it is limited in terms of its flexibility and its benefits. So deregistration under the Corporations Act, it is simpler, but it is only available if the company has ceased trading, it has assets under $1,000, it has no liabilities, and all of the members of the company agree to its deregistration. As there is no liquidator and it is a minimal cost to implement, however, the tax consequences will differ in that CGT event C2 would apply on the cancellation of shares, but if the assets are transferred to shareholders before deregistration, CGT event A1 may apply at the company level and the shareholder will acquire the assets at market value. In terms of the downsides of deregistration is that no franking credits can be declared or used and any tax attributes are effectively lost upon the deregistration of the company. If the distribution of retained earnings happens before deregistration, they may be treated as unfranked dividends or returns of capital, which would trigger CGT event G1. And importantly, if there are any assets left within the company, they will vest in ASIC or the Commonwealth under Section 601AD, which could present a real risk for shareholders. So on this slide, I've set out a quick comparison of the two approaches and the different aspects, which you can look at in your own time. But ultimately, we would want to use liquidation where there are material assets within the company or where we have significant retained profits or franking credits, whereas you would only look to apply a deregistration where you have a dormant, assetless company with no outstanding liabilities. Okay, turning now to earnout arrangements and how that impacts on the extraction of sale proceeds. So earnout arrangements are becoming increasingly common in the sale of businesses or significant assets, particularly where there is a gap in valuation between the buyer and the seller. These structures typically involve a fixed upfront payment followed by one or more contingent payments, which are only made if the business hits certain financial performance benchmarks post-sale, usually metrics such as EBITDA, revenue, or net profit. So from a tax perspective, these earnouts introduce real complexity because they don't just affect the commercial deal, they also impact on the timing of CGT events, how the capital proceeds are recognised, and also whether the small business CGT concessions can be accessed. And for a long time, the ATO's position under Taxation Ruling 2007/D10, it created real problems here, and it eventually triggered legislative reform. In the interest of time, I'll skip over the historical position and I'll just move to what we have currently. So the government introduced subdivision 118I into the ITAA 1997. So from 24 April 2015, the tax treatment of certain earn-out arrangements shifted to a look-through model. And if an earn-out qualifies, all future contingent payments are simply treated as part of the original CGT event, capital proceeds. And this gives far better alignment with the underlying transaction, and importantly, it makes those payments potentially eligible for the CGT small business concessions. But not every earn-out will qualify for the look-through treatment. There are strict conditions that exist under Section 118-560 in that the earn-out must firstly arise from CGT event A1. It must relate to a business or an interest in a business. It must be objectively tied to future performance of the business. It must run for no more than 5 years. And finally, it must not involve trading stock or fall under the TOFA rules. Each of these conditions are technical and they need to be met in full. So it's really important that the documentation clearly reflects each of these elements. Otherwise, the arrangement will fall back into the old, less favourable treatment. So looking at the CGT concessions, if the look-through regime applies, then the entire earn-out, both upfront and deferred, will be treated as a single capital proceeds figure for the original sale. And that means that the vendor, if they are eligible, they can apply the full suite of CGT small business concessions, including the 15-year exemption, the active asset reduction, retirement exemption, and replacement asset rollover. And this alignment can provide substantial tax savings to the taxpayer, but only if the structure is right and carefully monitored over time. On the other hand, if the arrangement fails to qualify, then the earn-out amounts will be taxed under CGT event C2 as separate and later gains. And in most cases, those separate CGT events won't meet the concession requirements, particularly the active asset test. So the benefit of the CGT small business concessions could be lost entirely, which could represent a massive tax saving that's been foregone. So how do we make sure that an earn-out qualifies for look-through treatment? Essentially, documentation is really key. We need to make sure that the sale agreement clearly links the deferred payments to the measurable business performance criteria. We need to make sure we're defining the earn-out period and also setting out how the contingent amounts are to be calculated. We often recommend as well that we have a dispute resolution mechanism within that agreement, such as expert determination, to make sure that the provisions are enforceable. I'm going to skip to the next section just because I'm mindful that I'm fast running out of time. Of course, you can download these slides and look through what I've got on here in your own time. But I'm going to move on now to the interaction of asset protection with tax-effective strategies for managing those sale proceeds. So when a client sells a business or major asset, the focus often shifts immediately to tax, but we need to remember that asset protection is equally important. because these liquidity events can introduce new exposure to creditor risk, tax inefficiencies, and also some compliance challenges. And the goal when looking at asset protection is to make sure that we structure the post-sale wealth in a way that protects it, not just today, but also against long-term risk. So for corporate groups, one of the first steps that we have is to move the sale proceeds out of the trading entity. That might involve declaring a franked dividend, documenting an intercompany loan on commercial terms, or perhaps undertaking a restructure. But we need to make sure that any such move is commercially justified and properly documented, Otherwise, it might risk failing under Part 4A. When looking at trusts, we know that discretionary trusts offer flexibility and strong protection, given that no one beneficiary has a fixed entitlement. Whereas unit trusts, on the other hand, they provide certainty of ownership, but they make beneficiaries more exposed. So that's something to keep in mind. As always, we need to consider bankruptcy risk and the various clawback provisions. So Section 121 will void transfers intended to defeat creditors. We've got Section 120, which targets undervalued transfers, and Section 120 subsection 3, which can extend the clawback period for related party transfers. There's also particular provisions dealing with self-managed super funds and excessive contributions to super. So each of these provisions need to be kept in mind when considering the asset protection of these post-sale proceeds. As always, insurance is a valuable second layer of defence, but it's not always going to hold up in terms of receiving those insurance proceeds. So I'm just going to skip to the recommendations that we have here in terms of choosing an appropriate structure to hold the proceeds after a major sale event. Firstly, make sure that we're engaging a specialist tax advisor who's familiar with the concessions, trust law, and restructuring. Legal review is also key, making sure that there's no exposure under the Bankruptcy Act. And of course, asset protection is not a one-off exercise. We need to make sure we're reviewing the structures regularly, especially as laws change or family circumstances evolve. And asset protection always needs to be proactive. If we've got any late-stage transfers that look like creditor avoidance, this is very likely to be challenged. So let's now briefly look at a case study to try and incorporate each of the different aspects that we've considered today. So we're looking here at the sale of Green Tech Proprietary Limited, which is a renewable energy software company founded in 2004 by Emma and Daniel, who are equal shareholders in the company. So after 21 years of operation, they've received an offer to sell the business for $10 million. And it's structured as a $7 million upfront payment with a $3 million contingent earnout to be paid over 3 years if certain revenue milestones are met. The company is a CGT small business entity, which potentially opens up access to the concessions. Looking at the balance sheet of the company, we've got 1.2 million in franking credits, $500,000 in retained earnings, and no other assets or liabilities. So Emma and Daniel are now wondering, how do we take out these sale proceeds from the company? And once we've done so, do we keep the entity or do we wind it up? So looking at the concessions, both Emma and Daniel are over 55. They're retiring and they've held their shares since the company was incorporated in 2004. So we can assume that it would qualify for the 15-year exemption under subdivision 152B. So as a result, the entire $10 million capital gain could be disregarded at the company level, and these proceeds could be distributed to Emma and Daniel as CGT concession stakeholders without any tax implications. Alternatively, they might look to use some other combination of the concessions if they did want to contribute those funds to superannuation, for example. Looking at the earnout side of things, the $3 million earnout would qualify as a look-through earnout arrangement under subdivision 118I because the earnout is contingent on future revenue performance, it's capped at a 3-year period, and is properly documented within the sale agreement. So as a result, it would be treated as part of the original capital proceeds and could be included in the CGT concession calculation, even though it could be paid 3 years in the future. So that provides a lot of certainty as to the concessions. We have $1.2 million in franking credits available, so they might consider retaining the company and gradually distributing the sale proceeds via fully franked dividends, of course, depending on their objectives with the company and their individual tax circumstances. They might look to alternatively wind up the company to have a clean exit. And so CGT Event C2 would apply to the cancellation of their shares, and those liquidation costs would be deductible. Asset protection, Emma and Daniel plan to reinvest in property and to launch a new venture. So they look to establish a discretionary trust to receive the sale proceeds that have been distributed to them. And so this will provide asset protection, income streaming, and also succession planning benefits for them. So to summarize the final outcomes and recommendations here, they decide to proceed with liquidation. So company distributes $7 million upfront under the 15-year exemption. The $3 million earnout has the same tax treatment under the look-through treatment. We use the remaining $1.2 million in franking credits to declare a final dividend using the $500,000 in retained earnings. And we move those proceeds across to a newly established discretionary trust to meet their future reinvestment objectives. So just to wrap up, noting that it's already 1 o'clock, I apologize, I had a lot to get through today. So managing the proceeds from the sale of a business or a major asset involves far more than just applying the tax legislation in isolation. We need to take a strategic, big picture approach to make sure that we're maximizing the post-sale tax outcome and also meeting the client's commercial goals. So I won't say any more given that we've already hit 1 o'clock, but feel free to download the PowerPoint slides and read through the rest of the information in detail. I'll pass back to Adrian now, if that's okay.
Of course it is, Kate. Well done. There was a lot to get through. We've had a few queries come through. I've logged them all, and Kate will come back to you separately on your queries. So recognising that we're out of time for the session and you may have other things to go to. You will receive a feedback email after the webinar. Please take the time to complete it. There's only a couple of questions, one of which is any future topics that you would like. Most of our topics come from requests from people who attend our webinars. So thank you, Kate, for your efforts, and thank you for attending.